Hello, and welcome to Vortexa's latest webinar, Trading the Oil Spreads, Forward Curves, Differentials, and Cracks. Greetings from deep in the heart of Texas and the capital of the energy industry, Houston, Texas. My name is Will Holman. I'm the lead analyst here at Vortexa. I cover market analysis across the barrel. I'm joined today by our product specialist, Connor Stone, who joins us with freight experience from his time at McQuilling & Partners. Our presentation today is going to be about 40 minutes, with about 20 to 25 minutes of presentation and 10 to 15 minutes of Q&A at the end. Anyone in the audience is welcome to offer questions at any time through the chat function on the right-hand side of your screen. We will answer as many questions as possible at the end of the session and get back to anyone whose questions we can't answer by the end of our time here today. Finally, everyone will receive a recording of this session as well as the slides via email later today. So today's presentation will explore various oil and product spreads through the lens of our fundamental flows data on the Vortexa platform. We'll begin the presentation with an overview of the main themes driving our outlook for the second half of 2021, specifically shifts in North American net exports, the implications of Chinese policy changes, and Middle East crude exports returning. Next, we will look at transforming commodities through time with forward curves. We'll look at U.S. crude export trends. We'll lay out the market shift from contango to backwardation with a more recent trend toward the flatter structure. And then we'll also cover forward curves versus exports. We'll then continue to look at transforming oil across time and space with an analysis of differentials. We'll analyze crude exports by destination. We'll also take a second to analyze how this market can be viewed through the Vortexa's freight platform before tracing the evolution of the WTI Brent differential and looking at that spread versus the share of exports that go to Europe. Finally, we will look at a spread that transformed oil across products, crack spreads. We'll first look at U.S. clean petroleum product exports by type. Then we'll look at product cracks and trends in those cracks before comparing product crack spreads versus transportation fuels exports. And as I mentioned before, we'll then close with key takeaways and the aforementioned Q&A. I always like to start a presentation with the key takeaways up front, so if you take nothing else away from today's time together, you should leave having heard the following. We expect crude market structure to weaken on rising Middle East supplies and slack Chinese demand, while North American import demands should rise. We've got the push of increasing supplies just as the pull from demand is lessening in the form of China, with the possibility of some upside from North American demand. Second, shifts in the forward curve could lead to increased stock builds in the U.S. The slightly flatter market structure this month could see the incentives for market players to begin to turn crude exports into stock builds here in the U.S. Next, the WTI Brent differential should struggle to keep the U.S. crude competitive in international markets and could lead to more Atlantic Basin crude staying in region. We've got sluggish supply growth in the U.S. limiting export availability as domestic demand has recovered from the February freeze and is emerging from COVID-related concerns. This is just as international supplies are rising, and together these factors combine to challenge the economics of U.S. crude in foreign markets. Finally, product cracks, specifically for gasoline, have driven refining runs up and led to greater product export volumes. As we will show, this has led to greater flows out of the U.S. We'll begin our discussion today by laying out the key fundamental drivers of oil markets in the balance of 2021 through three key markets: Middle East exports, Chinese imports, and North American net imports. The crude market structure is set to ease on factors from these three key markets I just laid out: China, the Middle East, and the U.S. In the Middle East, we expect exports to rise, and we expect these exports to really target Asia. With OPEC Plus's relaxed production constraints, Middle Eastern crude exports are expected to rise by roughly 1 million barrels a day in the remainder of 2021. Historically, we've seen about 80% of Middle Eastern crude exports land in Asia, and we see limited reason for a major decline in that share over the coming months, even though we saw some easing established at the margins earlier in 2021. On the flip side of the trade, the Middle East traditionally supplies just over half of Asian crude intake over the last year, highlighting the importance of this flow for both sides of the trade. However, demand in Asia is unlikely to increase due to developments in China and COVID-19 related restrictions, meaning that Atlantic Basin crudes will be displaced. This will pressure crude differentials and market structure as already emerging throughout August, especially in West African markets where producers have struggled to place their summer programs. As you can see in this graphic, Asia's share of Middle Eastern exports is returning to historical norms after testing new highs over the previous year at the height of the production deal negotiations, really. So we expect higher Middle East exports to continue to be aimed at Asia. As supplies are rising into the region, China, the largest purchaser of crude in Asia, has taken some dramatic steps to rein in its refining sector. These steps have far-reaching impacts on Chinese and wider global crude oil flows. Effectively, the Chinese government has made a U-turn on oil policy. In order to ease inflationary pressures, as well as environmental concerns, China is cracking down on crude oil imports and refining operations that go beyond domestic needs. Crude import and product export allowances have been adjusted accordingly, and taxation loopholes have been closed on intermediate products and other forms of obfuscating the true origins of crude oil going into Chinese refiners. As a net result of all of these policy changes, crude imports have been falling steadily throughout 2021 into China, and we see limited chances that they will average above 8 million barrels a day in the second half of 2021. This would leave crude imports down by about 1.5 million barrels a day compared to the first quarter of this year and the last 2 years' averages. Rising supply and falling demand paints a grim picture for crude in the coming months if it wants to find a home in China specifically. There is one potential bright spot for crude flows over the coming weeks and months in the form of North America. We've seen falling exports and rising imports throughout this year into North America when you take Canada, the US, and Mexico as a whole. We've seen crude imports rising in every month for the last 6 months, and we've also seen that net imports, or the difference between outflows and inflows, has been zooming in on the zero level here in August so far. This would be for the first time since first half of 2019 that the US, or not the US, but North America in general would be in a net import, potentially in a net import position overall. Net imports are potentially, like I said, coming in towards zero, but they're a far cry from the peak of 2.3 million barrels a day of net outflows briefly reached in last December. If you turn to the EIA's short-term energy outlook for a view into the upcoming months, what you'll see is that they forecast U.S. crude net imports of about 100,000 barrels a day higher in September to December 2021 as compared to the previous 4 months around the peak summer driving season. Over recent months, the increase in imports was driven by stronger refining operations, or a pull, but going forward, U.S. crude will face more difficulties in exports markets, more of a push, allowing for well-needed restocking amid weaker market structure. Having laid out the fundamental factors that will drive oil markets in the second half of 2021, we can now discuss various methods of transforming oil through time, place, and form. If, as we expect, U.S. barrels will struggle to be placed in Asia, then those volumes will need to stay in the Atlantic Basin, either through foregone exports going into stocks or increased volumes finding Western Hemisphere end markets. With that, I'll turn it over to you, Connor, to take us through our first spread.
Great. Thanks, Will. So our first oil transformation we'll examine is the forward curve, or transforming oil through time. So if we move on to the next slide here, I first kind of want to lay the backdrop for the U.S. crude export market as we've seen it over the last year. So if we look at year-to-date volumes, we're averaging around 2.8 million barrels per day, with a stronger Q2 as compared to Q3 so far and Q1 of this year. And we know Q1 of this year was dampened significantly by the freeze in Texas that caused a significant disruption to operations in the upstream sector. So if we look at the graph on the right here, we can see the month-on-month change in those aggregate volumes. You can see that the drop in February was quite steep, to the tune of about 920,000 barrels per day. Now, we did slightly recover through June with a bit of weakness in May, and June would be the highest month that we've observed so far this year. So edging above the 3 million barrel per day mark there. Now, since then, of course, we've seen some downward pressure on U.S. exports. So with July dropping down about 660,000 barrels per day on a month-on-month basis. So not quite as high as the decrease in February, but quite close, especially when we compare to more other months of the year. So what's leading to the recent declines is ultimately, as Will was mentioning, increased refinery runs, recovering much faster than upstream production. So we have a tighter balance of inventories to export. So that lays some of the backdrop of what we're seeing in terms of U.S. crude exports. But let's move to the next slide here and actually talk about pricing and the forward curve. So if we look at the yellow line there, that represents the forward curve from November. So we can see as recently as last year, the curve was, of course, in a contango structure, incentivizing producers to store crude oil and sell it later at higher prices. Now, since the turn of the year, that has flipped into a backwardation structure with flat price increasing. So, of course, that is going to incentivize discourage any sort of stock building. Now, I think what's most relevant to this discussion and perhaps more interesting is if we focus in on the orange and blue lines there, which represent the forward curve for July and August. So we can see that August is definitely flattening in comparison to July. Now, while this doesn't represent a contango structure, it could lead to more barrels staying at home. We may see, some incentives for, inventories to build here in the U.S., especially if we consider that about 80 million barrels were drawn between March and August. And ultimately, it looks like this flattening of the curve is quite reflective of what we're seeing in terms of weaker global oil market fundamentals. So that kind of lays some of the backdrop for U.S. exports and what we're seeing on the curves. But perhaps, Will, if you'll jump in here, maybe tie the two together.
Yeah. So with an eye towards tying all this together, we've got lower availability of export outlets pressuring U.S. pricing, while this forward structure shift could encourage stock builds that Connor just laid out for us. So if we start on the left-hand side of this slide, what you'll see is that exports fell off in July and remain at similar levels in August so far. Previously, exports fell off in February because of the freeze, before growing strong through the spring, stalling out in May, and as I said, sitting relatively flat in July and August. We had impressive growth in the immediate recovery from February's lows, but this growth slowed in the spring and early summer, and July's declines have only been partially offset by August's uptick. Moving to the middle graph here, we can really see the flattening of the curve and how this may be starting to begin to give incentives to keep barrels home. A couple of things of note to call out here, because here we've got slightly different curves. We've got the August, July, and June curves here. The first move to note is that flat price rose from June to July, while the forward curve shifted into a greater degree of backwardation towards the out months. So actually, going into July, we had less incentive to store crude, and we had less incentive at the tail end of that forward curve. But then prices fell from June to July, while the curve simultaneously flattened out, diminishing further the incentive to pull barrels ahead of a comparatively smaller price decline for future volumes. Taken together, these moves could see greater volumes of U.S. crude stay home and fill inventories. And that's kind of the message of this graph on the right here. This is a lens that I've borrowed kind of from my friends over in gas market analysis of a year-over-year inventory position versus exports. As stocks moved from a year-over-year surplus to a deficit at the end of Q1, we saw inventories begin to plummet. As Connor noted, they're down some 80 million barrels since March. Notice especially the strong pull on inventory as exports held up through April and May, then took another down hard turn as June's exports materialize. So as that last bump in the blue line really comes into June, you can see that the orange line really starts to get pulled down as those exports are drawn from stocks. Now, as exports have relented over the last 6 weeks or so, we have seen inventories begin to recover. We've moved from a maximum year-on-year deficit of around 100 million barrels to now just down 80 million barrels from a year ago levels. With all that, I mean, it's just really interesting to me that our data can show the effects of changes in the forward curves and their structure on the market. But of course, there are more than just time spreads out there. And so I'll leave it to Connor to introduce our next spread.
Okay, great. Thanks, Will. So next we'll turn to the spread that transforms oil across time and space. So the WTI Brent differential. And in this case, we're speaking to WTI delivered in Northwest Europe versus North Sea dated Brent. So moving on to the next slide here, again, I want to lay the backdrop in terms of Vortexa's cargoes flows data before we actually move in to speak to the spread. So within this chart here, we are providing Vortexa's cargo flows data broken out by destination. And of course, we're talking about U.S. crude exports. So in the blue bars here, that will represent all the volume we've observed to Asia. Yellow bars would be volume to Europe, and the gray bars would be the rest of the world. So what we're clearly seeing here since the beginning of the year is a shift in focus to Europe as more volumes start to travel across the Atlantic versus going the long route to Asia. If we focus in on those Asian destinations, we've seen their share of U.S. exports drop from 50% in Q1 to average around 44% since April, with July being particularly weak, down to about 40%. On the contrary, European destinations took about 770,000 barrels per day in the first 3 months of the year, and that's increased about 42% to average about 1.1 million barrels per day since Q2 of this year. So again, we're seeing this big shift in volumes to Europe. And this shift is actually persisting even in our preliminary data for August, which so far suggests that Europe would be the most popular destination. However, as these longer haul voyages to Asia progress and final destinations become clearer, you're likely to see that blue bar come up while the gray bar may come down slightly. So there will be a bit of a rebalancing of that data, but again, we're likely to see the consistent trend of more barrels making their way to Europe. So this is through the lens of our cargo level data. But if we move on to the next slide here, we are uniquely positioned to transform our cargo level data into key metrics for the tanker market to focus on analyzing both the demand and the supply side of the situation. So as we think about the tanker market, a key metric is ton-mile demand, of course, to measure the relative health of demand for vessels. So we are seeing this shift to Europe reflected in that data set as well. On the left-hand graph, you'll see crude ton miles from the U.S. Gulf Coast to the wider world. The gray bars will represent that volume or that demand to Asia, and then the orange bars is going to represent that to Europe. So if we look at the market as a whole, we saw about 23.6 billion ton miles generated in January. This did find some pressure in the following months, but ultimately it came up to about 23.4 billion ton miles in July. So slightly lower compared to January, but fairly on par. Now, what's very different, though, is the makeup of destinations. If we look at July, we see an increase of demand to Europe of about 24% compared to January. So we can see that the European market is definitely contributing more to ton-mile demand out of the U.S. Gulf Coast versus Asian players. So now breaking this demand down by vessel class, on the right-hand graph, we can see that this, of course, is going to be dominated mostly by the VLCCs, and that demand is largely trending similar to demand to Asia. But what's perhaps more interesting is the reduction of the red bars. So that represents Suezmax demand. So we're seeing the Suezmaxes come under considerable pressure, with demand decreasing since the beginning of the year, and this is largely on the back of lower volumes to the Far East and India, while the green bars have been growing, up about 24% in August compared to January, and that's for the Aframaxes, which of course benefit from more trading to Europe. So again, we're seeing this shift in Europe reflected in both our cargo level data and in the ton-mile demand data for the tanker space. But what's quite interesting, if we move on to the next chart here, is that although you've seen this shift to Europe largely benefit the Aframaxes, we also did see an increase in Suezmax trading along the trade. So here we're focusing on ton miles from the U.S. Gulf Coast, specifically to Europe. And what we've observed here is, of course, a large gain in volume, in demand on the Aframaxes, but also a temporary bump up in May from the Suezmaxes. We actually saw about 20 Suezmaxes loaded for the transatlantic trade in May. So what really drove that? Well, what drove that is we have this increase in volume, of course, going transatlantic, combined with also a blowout of the differential between the Aframaxes and the Suezmaxes on this particular trade. And that's shown in the graph on the right. So if we look at the graph on the right here, we'll see the Aframax's 5-week moving average spot rate graphed in the orange line, and then the blue line will represent the Suezmaxes. Then the gray bars will represent the differential between the two. Now, the Aframaxes are typically going to be more expensive due to economies of scale, but we did see temporarily in late April that the Aframaxes jumped up considerably while the Suezmaxes remained fairly stable. So you saw this differential rise to about above $1 per barrel, for about 3 to 4 days in late April. So this resulted in a flurry of Suezmax chartering, which resulted in more cargoes being loaded on those ships in May. Now, this wasn't sustained, of course, as this differential tightened yet again. But as we think about more barrels being traded in the Atlantic Basin going forward, you may see more opportunity to take Suezmaxes on the transatlantic trade, especially when we think about that overall picture for Suezmaxes has been so positive. You're seeing demand declines, but you are seeing some uptick in demand from the Brazilian market and the West African market. So if we have more Suezmaxes trading in the Atlantic Basin, you may find some more opportunity to take larger cargoes on the transatlantic trade. But ultimately, this is all going to be dictated by how freight rates play out and how the WTI Brent differential plays out. So I'll turn it back over to Will to speak to that differential.
Yeah. Speaking of the WTI Brent differential, and here we're dealing with WTI Houston that's delivered to Rotterdam versus North Sea dated, all thanks to our friends at Argus. Recent strength in the WTI has seen the differential to Brent swing to a premium. WTI averaged a premium to Brent over the first quarter, disadvantaging the U.S. crude in international markets. February's strong premium can be attributed to relative scarcity of U.S. barrels due to upstream issues caused by the freeze, obviously. But the differential came back in through March and before flipping to a discount in April through June. So far this month, WTI has returned to a premium versus Brent, suggesting headwinds for exports in the near to medium term. Recovering refining runs again against a backdrop of slower production growth, as well as limited crude import demand from Asia, places upward pressure on domestic pricing, squeezing the differential. Now, having laid the backdrop, we can explore how these dynamics map specifically onto crude flows. In the graph on the left here, we can see that from before that the volumes to Europe stepped up in April just as the WTI Brent differential was experiencing its greatest monthly discount, and volumes have since stayed relatively close to this level. As total exports were falling through July and into August, the share going to Europe went up, but it was really the volumes to Asia which took the brunt of the hit. Moving to the middle graph, as the differential has come in since April, we have seen lower exports as U.S. crude was comparatively less competitive in foreign markets. In the graph on the right, we bring the flows and the econs together to show the increasing share to Europe through time. There are really two dynamics at play here. The share to Europe increased in the first half of the year as the economics of U.S. crude and international markets improved, as measured by the WTI Brent spread. But the uptick in shares in July and August is more tied to the previously mentioned flat volumes to Europe against a falling top-line number. So while that number increased with improving economics through the first half of the year, that share to Europe I'm talking about here, it increased in July and August really due to flat volumes volumetrically going to Europe, but a falling top-line number. So the share went up basically by arithmetic. While the relationship between the WTI Brent spread and exports is complicated, the effects of the spread on flows can be seen through our data. Having covered forward curves and differentials, we can now turn to a different type of transformation.
Great, thanks, Will. So the final oil spread we'll consider today transforms oil into another finished product, so product cracks. So before Will kind of takes it away here and jumps into speaking specifically to the cracks, I wanted to again lay the backdrop of the U.S. export market, but now through the lens of refined products. So excluding the dips that we observed in February and March, again, due to foregone runs on the back of the Texas freeze, we have seen month-on-month gains in terms of these product exports, rising since April. And we touched about 2.4 million barrels per day in July, which is up about 27%, when we compare that to January. And now when we look at August, we have pulled back slightly according to our preliminary data, just under the 2.4 million barrel per day mark, but this has the potential to go higher as we finish out the month. When we look at the product breakdown here, which we've shown in both the left-hand and right-hand graphs, gasoline, of course, is the main demanded transportation fuel domestically in the U.S. So this export market is naturally going to remain diesel heavy. We've seen exports for that product average around 1 million barrels per day since June, while gasoline is averaging about 720,000 barrels per day over the same period. Now, July and August were slightly stronger for gasoline, and it's really a low June number of under 600,000 barrels per day that's bringing that average down. But as we look forward, I think the outlook for this market is going to be positive, especially when we consider coming out of summer driving season. That should be good for gasoline exports, but we believe diesel exports are on pace to grow as well. But again, I'll let Will speak to what's really driving that with the product cracks.
Yeah, and here we've got the monthly product cracks for 2021 across the major refined products. Looking at the current state of crack spreads, gasoline has really been the headline number. It's increased, and this is seasonal, but it has increased, taking cracks from the mid-single digits in the start of the year to the mid-teens so far in August. And this is a relative doubling of the margin on gasoline, but this is not seen in other products. It's really just the gasoline that's seen the strongest runs. I mean, we've seen strong refining margins in the U.S., and they've been driven by resilient transportation fuels demand. I mean, the EIA reported the highest single week of gasoline demand on record, just over 10 million barrels a day in the week ending July 2nd, as pent-up travel demand from lockouts met the holiday driving season. And as Connor noted, the recent weeks have shown a decrease in demand from record highs. Weekly data is consistently outperforming seasonal norms well above 2020 levels. Margins were buoyed in March and April by depressed runs as Gulf Coast refiners took longer than expected to recover from February's freeze. Looking forward, what we really expect, though, is that margins should come in seasonally with the looming shift to lower margin winter grade gasoline. But the question is if the impending fall in margins or in crack spreads will translate into fewer runs above and beyond the autumn maintenance season concerns. So if we take a look here, and we look at the responsiveness really of gasoline and diesel exports to crack spreads, what you'll see is that gasoline exports have followed cracks higher, while diesel exports have shown themselves to be generally less responsive to the crack spread. In the graph on the right, you can see in the graph on the left, I should say, you can see the clear tie between gasoline exports and the crack spread there. Diesel in the graph on the right shows a clear increase in exports throughout the year in tandem with increasing runs, but it doesn't seem to be as tied to the crack spread directly. More than anything, we get additional diesel when we have additional runs that are incentivized by a higher crack spread for gasoline in the US, since that's our main transportation fuel. Diesel kind of comes along for the ride, really. If we want to tie all this together, though, and return to our key takeaways, I just want to reiterate here so far today that what we've shown. So we expect the crude market structure to weaken on rising Middle East supplies and slack Chinese demand. Supply increases and demand decreases in the key market of China spell a dim outlook for U.S. crude in Asia, though the North American market may provide a bright spot for stranded barrels. And again, the shifts in the forward curve could lead to increased stock builds in the U.S. While the curve is still solidly in backwardation, it has flattened somewhat recently, perhaps indicating the beginning of stock building pressure. The WTI Brent differential should struggle to keep U.S. crude competitive in international markets and lead to more Atlantic Basin crude staying in the region. Any U.S. cruise that finds a home in Asia will have to price itself to be competitive, perhaps at a level that will keep barrels on shore in the first place, and at least presents the considerable headwinds to placing U.S. barrels outside of the Atlantic Basin or the Western Hemisphere. Finally, product cracks, more specifically gasoline, have driven refining runs up and led to greater product export volumes. Gasoline markets have shown themselves to be more responsible to the crack spread in the form of exports than diesel. It's important to keep scale in mind, though, and diesel exports continue to outpace gasoline flows. And with that, I think we can turn now to the Q&A. Connor?
Great. Okay, let's move to the Q&A. So I see some questions coming in here. Will, how about this one for you? So do you see North America returning to a net importer of crude oil?
That's a great question. I think the short answer is no, and the longer answer is no, but it's not going to be as strong of a net exporter as maybe we would have envisioned if we were giving a forecast 18 months ago in a pre-COVID world. The main swing in the net import equation will be U.S. exports. As far as waterborne export volumes are concerned, the Mexican and Canadian volumes are fairly priced in, and they come in ratably, about 900 KBD of Mexican exports and about 100 KBD of Canadian waterborne exports, respectively. But the question of how well they hold up over the coming months will determine the net import position of the region. So if you think about the exports, everything's priced in but the U.S. side. If you think about imports, everything's priced in. Mexico doesn't really import. Canada brings in about 200,000 barrels a day, but the U.S. at about 1.9 million barrels a day over the last year really dominates everything. So it's the relative size of those two flows. How much more can imports increase, and then what will be the reaction of exports that'll really tell the tale of whether we're a net importer or a net exporter for the region. I'm looking here. We've got a question for you, Connor. How does Vortexa track ton miles?
Okay, that's a great question. Well, it's quite different to some of the traditional methods that we've seen historically in the market. So traditionally, a lot of players will kind of look at country-to-country trade flow data, and that's typically aggregated on a monthly basis and then back into ton miles. And those are typically portrayed on a region-to-region basis. But what Vortexa is uniquely positioned to provide is we're able to track each individual cargo movement. So we can turn that into our ton-mile data because, of course, we understand the cargo being loaded on each given ship, and then, of course, the mileage traveled for each vessel. So it gives us the capability to look at ton miles on a very specific level. So we can look from one port to another, or we can even go down as far as the terminal level. So it allows you a more precise understanding of within real time, because we can do it at a daily level as well, what is actually occurring in the market and how vessels are trading across different trade lanes. So it's turning those cargo movements data into that key metric of ton miles for the tanker space.
Yeah.
Okay, so we can go maybe back and forth here, Will.
Sure.
See, there's another one here. So, what is driving August's fall in exports destined for Asia? And I believe the question's around U.S. crude.
U.S. crude. Okay. Yeah. So in part, it's the beginning of Chinese reluctance to buy U.S. crude. You've got lower import quotas and increased government pressure to limit runs. That's really pinched off Asia as an outlet for U.S. barrels or made it that much more difficult to find a home there. It's not as bad as it may appear, though, because there's also the issue of longer sailing times to Asia than to Europe. And this is kind of on a note that you brought up, Connor, where because of the longer sailing times, it takes longer for our destination model to pick up a final destination port for a shipment from the U.S. to China, say, relative to a U.S. to Europe shipment, which could be there in 2 weeks, all told. So as Connor pointed out, what we would expect is that the volumes that are currently marked for rest of world, some of those will end up in Asia. So that Asian blue bar in slide 18 will go up. But the total volume is pretty well priced in. So we know exactly what's left. And it's just a matter of how we're going to split that pie going forward. Looking here for you, Connor. Yeah, let's see here. We've got a couple of questions around our outlook on freight. So do you have a succinct summary, or do you have what is our outlook on freight for the coming weeks and months?
Sure. Yeah, I can definitely speak to that. So it's certainly not bullish. Of course, we have some demand considerations now, especially on the crude side, and of course we're still in this market where there is plenty of ships versus cargo. So the continued oversupply is likely to keep pressure on freight rates going forward. And as we think about maybe the Atlantic Basin market and considering that more barrels are trading within that market, especially from the U.S. to Europe and so on, that bodes better for, let's say, the smaller vessel classes versus the larger VLCCs. So, until we start to see those longer haul movements from the Atlantic Basin to Asia kind of pick up again, from the demand perspective, it doesn't look very bright for freight rates. But again, this is a story of oversupply in the market from the vessel side. So until we see that demand side really, really pick up, you're likely to see pressure on freight rates going forward. Okay, great. My turn to pick. Let's see. I think we've got another one here for you, Will. So why have diesel exports stuttered this summer?
Good word choice. I like stuttered. That's strong. Okay. Well, honestly, this is again a function of the U.S. being a gasoline transportation market. As I mentioned in the slides, if you look at slide 22, you'll see that outright diesel cracks have really doubled, outright gasoline cracks have doubled this year, moving from $8-ish to $16-ish from January to August. And like I said, some of that is seasonal, just because you've got higher margin transportation fuels this time of year. But U.S. drivers did take to the road and they burned lots of gasoline. Refiners were incentivized to produce more gasoline at the margins and to really shift their yields away from diesel and towards gasoline for this, specifically this driving season. So consequently, less diesel just falls out of the balance for exports. And again, we're seeing month over month kind of stagnation in diesel exports, but it's again important to remember scale. Diesel is still exported in greater volumes than gasoline, and that's going to continue going forward. Now it's my turn. We've got, good question. We haven't really touched too much on here. So Connor, what do fuel oil exports look like out of the Gulf?
Right. Yeah. So if my memory serves me correctly, it's definitely been a story of growth, as with the other refined products. I believe we were just below the 90,000 barrel per day level in January of this year, and I think the last figure I saw was for July, which was above the 200,000 barrel per day mark. I think around 240, maybe 235. And this actually was the highest level that we observed so far this year. So it's definitely been a story of growth. And again, here at Vortexa, we're able to identify whether it's high sulfur or low sulfur fuel oil. And we're seeing that about 63% of those volumes are typically the high sulfur fuel oil. So again, a story of growth along with the other refined products.
Yeah.
Okay, great. I think we probably have time for one more question.
Okay. Let's see here. So I've got one here that I can take a stab at, maybe to close us out, and it's a good question, kind of thematically around the whole presentation, and it says here, how quick, based on our fundamental view, can the curve shift to contango and incentivize storage plays? And this is one of those classic questions in market analysis. I mean, the real answer is it could switch whenever market sentiment takes it that way, right? But practically speaking, I think it's something that, and we're only now starting to see the very beginnings of this, but if it was to switch to contango and storage plays became economic, it would be a process of probably weeks and months worth of price signal before you'd start to see storage come into play. But we might be seeing the beginnings of the curve flattening, which might keep more barrels home for the following season. Yeah.
Okay, great. Well, I think that's our time, everyone. Thank you all for attending. You'll find that our emails and contact details will be on screen. If there are any unanswered questions, we will get to those. At the end, there's going to be a small survey on screen. So please feel free to provide any feedback. It's very much appreciated by us. And just a reminder, you will be receiving a recording of the session and the slides via email afterwards. And of course, if anybody wants to learn more about the data behind the presentation and how Vortexa can benefit you, you can go ahead and request a demo on our website or reach out to our contact details on screen. Thanks, everyone.